anyone who thinks they can create like a spreadsheet or even like some giant AI model and plug in data and it will tell them just magically and accurately, should you buy or sell a stock?
Now, speaking of inefficiencies in markets, this is kind of curious. When I'm looking at this chart here, usually the inefficiencies exist in small companies because the market hasn't really found out about them and they're growing at rates that are unusual.
That's not work. That's actually like hobby and passion. It's interest. But I learned something about the company at the same time.
Still clouding people's perceptions because it's been a long time that this company has been in the dumps.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Welcome to the Deep Investing Jungle with your hosts, Luke the Badger Hallard and Christoph the Monkey Piekarski. On this week's show, we've got some thoughts and some hooting and hollering on our episode 100 Fiscal AI contest. I want to chat about doing a reverse discounted cash flow model, and I'm going to give you guys some tools to do it with that'll make it super easy. We've also got a bunch of Patreon questions, and two we want to pick out are how much time should you spend researching stocks? And also, maybe critically right now, how do you insure your portfolio against a potential downturn? And then, Christoph, we're going to get into some options shenanigans. I want your help picking out some more quantum computing puts.
Oh my goodness, Badge. So we're fresh off episode 100, the live stream extravaganza, which was fantastic, right? We had a lot of fun. It was really kick-ass getting to interact with our Patreons. But now we're back in the saddle, back to business, doing reverse DCFs and option analysis for you beginners. Please don't run away because I know it sounds awful.
It's something we're going to probably do a bit more of in future episodes. We're actually going to start showing you how we really use some of the investing tools that we have in our toolbox, like fiscal.ai, one of our favorites.
Yes, sir. You know what Monkey woke up to this morning, Badge?
Tell me.
You know what my routine is now. Actually, I've because there's not enough hours in the day. I have no bandwidth, as you're always clawing me about. So I'm now getting up at 5 in the morning and getting my butt into the gym. And while I'm at the gym, I'm doing stupid research for for our pod and all the investing stuff between sets. I'm that guy. I'm that guy now with the you know. So anyway, there I am minding my own business. Putting up the weights, and I see that AMD is up 35%. This is a what 200. If you fit, can you fiscal AI right now as I'm talking? uh AMD was on my potential 10x stocks. It was my latest addition. And I put that while it was a $250 billion market cap or something, so it was huge. So my expectation for it to 10x would be that would get to what, 2 trillion. It would join the ranks of the trillion club. And lo and behold, this morning it made a significant step in that direction.
I spotted that, which is why I'm drinking from my monkey coffee cup today. Yeah, I knew this was going to be a good day for you. It's right now, like in a week, you've done it yet again. It's now a $334 billion company. So
It's insane. So the high level overview of what happened is that OpenAI seems to have its paws in every honeypot around. uh, Committed to a strategic partnership with AMD, and it already has one with Nvidia, right? But we all know that the general market is kind of terrified that Nvidia is sort of a one, it's the one place you can go. So the fears of monopoly were, I think, legit. So this is the beginning of the kind of divergence to an equally huge partnership with AMD via OpenAI. And so the partnership was for them to OpenAI committed to deploying up to 6 gigawatts of power using AMD infrastructure. That's part one. So that's massive, right? That's a lot of chips needed. But two, It says my summary says that AMD has issued OpenAI warrants to acquire up to 160 million shares of AMD stock at a nominal price of 1 cent per share, potentially giving OpenAI a roughly 10% stake in the chip maker valued at over 26 billion based on recent prices. So the way I'm reading this is, well, there's two important things. Yay for AMD because this is huge money. Two, it seems like OpenAI with its, and I guess just all of this AI hyperscaling space is going absolutely cuckoo bananas, and the capex being spent are is preposterous. And some people are talking about like, where's this money coming from? Like this guy like one hand feeding the other. Like I'll give you 100 million in stock, and now that my stock is higher, I'm going to give you right, and it's this invisible flywheel kind of thing happening.
Yeah, totally. It's like that. I've seen that Three Stooges sketch like surfacing on even before the AMD deal was announced, because something similar happened last week with like Intel and Nvidia and like the US government. Like everyone's kind of buying bits of each other, and like the Three Stooges sketch is just like Larry, Curly, and Moe like settling their debts by passing like the same $10 bill around and around the circle a couple of times.
Right. So here's the main thing for me. Cool that Monkey has AMD in portfolio. Hopefully, our members and the other Wall Street wildlifers do too. This is proof. So, yay for thesis. Two, OpenAI seems to be potentially another future trillion-dollar company. I mean, they're I don't know. The money is speaking is how I'm taking it, and the money is flowing through AI via Nvidia and AMD. So it seems like yeah, they're going to be the AI guys in one way or another. Three, and this is what I want to talk to you about, kind of workshop this idea. We talked about it before, the analogy between the when the internet was being born and now this AI boom. Couple of things. It bears repeating. The internet boom was a bubble, and when the bubble popped, it popped hugely, and I want to say most of what was popping was garbage, meaning it was not substantiated by any real money, right?
Yeah.
Now, I would say we are also in a bubble because the asset prices are rising just so quickly, and the flywheels three stooges thing you were just talking about. So I don't, yes, we are also in a bubble, but I this is what I was thinking about this morning, Badge. When I was at the gym, I was like, how many times in human civilization do you have all these things lining up between technologies and network effects and GPUs coming to fruition and this alien intelligence landing and the rate of acceleration going. And now that's being backed by what? Approaching trillions of dollars in capital expenditures by companies that have the money. Oracle has the money, and Meta has the money, and Tesla has the money, and like all these people have the money.
Right. Okay. I hear what you're saying, but it could still be a bubble. And the reason is,
Wait. I did say it's a bubble.
I know, but it could still be like, yeah, I agree. Okay, I agree. We're both agreeing it's a bubble.
Both are bubbles.
Yeah, yeah. But you're saying this time is different, perhaps because this is backed by real money. But
Well,
maybe,
and wait, complete that. It's backed by real money, and I'm also saying another maybe brand new moment in human civilization, sort of like the internet, but this time more confluences beyond just like email and whatever was happening in 95.
no, I get that. Let me make my bear case on this. I'm not a bear on this stuff. Like I'm an AI optimist, but it could still come really badly undone because you're right. Like this is real money, but these companies like Meta and Alphabet and Amazon, these guys are spending like committing to trillions of dollars of capex spend over like multiple years, and um, and that's contingent on their valuations, and their valuations are contingent on AI being real. Like if AI shows like if okay, so let's say like the end users, like the B2C companies, if they can't monetize AI in a meaningful way, they can't get like efficiencies and like do more with less, and so you can't create commercial value with AI. That's what's going to kill it. And if that happens, they'll stop spending, and then like the metas and the guys who are providing all the infrastructure will go, shit, like the money's actually not here because our customers are not spending anymore. They stopped growing their spending, so they'll have to stop investing, and then the tide is going out, like Buffett would have said, and these guys are all there with their pants down because they've committed to these like multi-trillion-dollar capex spends, and the whole thing just kind of cascades and like slips into the sea. Um, so yeah, I agree. Like this isn't .com where you've got business models that are just fantasy, and there's no ability to actually do e-commerce because it's so immature. This is real, and we think people are generating value with it, but it's like how much value can you generate, and does it justify the trillions of dollars of spend in this big circular economy?
So let me see if I could summarize what I think you're saying. In the end, your question is the hype behind the AI in general does it translate to actual value produced in the real world? Now, I'm going to think through this live with you. During the internet, I mean, there's the pre internet world and the post internet world. And while it was kind of unfolding, nobody could potentially imagine what the world would be like 15 million, 10 years later, right? All your banking done. I mean, it was just, right? Okay. But value was created. Right now, in this moment, the sort of rebuttal I would give to you is that a company like Tesla and Google, Waymo and robo taxis are solving what I would argue what the most complicated thing imaginable is, like getting cars to drive themselves in complex situations that are just absolutely infinite, and that's using all of these networks. And I think
And sorry, and we're not there yet. And that would be true massive economic value if a company could actually deliver, 99 point all the nines you need to have a reliable FSD autonomous driving system that didn't like murder people and cause accidents. But we ain't there yet, and we may never get there. That's that's one of the questions, right?
right. Well, see, this is why I think this particular moment today, October 6th, 2025, is so fascinating. On one hand, I agree with you, we're not there yet. And every Saturday morning as I'm driving after my run in Austin, I'm surrounded by 20 cars with nobody driving them
Yeah.
now. And so my assumption is, and I think you and I share this, we're optimists in general. We acknowledge things take longer than most people expect. But if I had to bet right now in a binary way, will it or won't it? I'm taking the it will. I'm
I agree.
taking yes. This thing is gonna, and the fact that these trillions of dollars are flowing behind it, I'm saying, to go back to the original point, it's a bubble, but it's a bubble that has the most, I guess, unusual or not unusual, most um God, what am I? Not unusual and not most, but the rate, the forces, the winds that are almost like willingness into existence are so massive that it feels to me when the bubble pops, because all bubbles do pop, there are going to be many, many more substantial companies left standing. And the ones that basically powered, the whole thing, like an AMD, will not be popping.
Yeah, and like everything happens so much faster, and it's like faster and faster at an increasingly fast rate. So you're right, it took Like, how long did it take really the dot com bubble to burst, to go from like, peak of overhyped to bursting to then actually realizing real value and like stocks kind of turning around? That's probably what, 6 or 7 years, something like that, ballpark.
Oh, you think it was that long? I thought it was around 2.
Well, I mean,
Oh,
things started to
you're
go.
talking the turnaround, oh, the whole cycle.
Yeah, 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 yeah.
Oh,
Till like everyone was back in like growth on mode. Anyway, somewhere like that, that ballpark.
sure. Let's call it 5.
Yeah, yeah, 5 year. Like that's going to happen so much quicker this time. Valuate like we're going to look at some valuations with the tool of a reverse discounted cash flow model a bit later this episode, and some stocks, AI fever stocks, are just wildly overvalued, and they're going to take a pounding when the bubble bursts, which it must do eventually. It may not be this year, it might not be next year, but they will eventually. Like all things must end. And we're here to like hold your hands when your pants fall down, because our pants are going to fall down at the same time, right? So, but things are. I no longer really fear like a decade of stagnation that we may have had like back in the 80s. I'm not really a historian, or we may have had back in the 1930s. I think we're gonna see, because you're right. Like there's real companies doing this stuff, and if AI spend proves to be like a white elephant, companies like Alphabet, like they're still just generating a crap ton of real money with their traditional business models. And okay, if they overspent on AI capex and they have to wait for the world to kind of catch up with that spend again, that's still going to happen in like a couple of years as maybe model efficiencies, and there'll be like a few more deep seek moments, and suddenly we might need like 10x or 100x or 10,000x the compute. But at some point we're just gonna rush into that point where we truly have created like a super intelligence.
It's what never been a more fascinating time to be an investor, I would say. I mean, it's nuts to say that this stuff is making the internet boom seem like kindergarten. I mean, it's kind of wild. But my wish for our listeners and our Patreons is to keep the hype. Uh, like, don't dismiss it just because it's hype. There's a reason for it, and also just do your psychological prep work for the moments when there's going to be volatile popping of bubbles, and try, and this is I think what we're good at, or if I may be maybe a little self congratulatory, I'm always trying to think in that contrarian way and look for places where people are ignoring. uh, why do I have AMD instead of Nvidia, for example, in my portfolio? It's not that I don't absolutely adore Nvidia, the company, but there was this period where AMD was being overlooked. And now, right, that's the investing piece. Like you don't want to get caught up in the hype. You want to position yourself intelligently. So that's what we're here for. Anyway, so that's the AMD story. Uh, quite the morning news.
Yeah, well played, well played. And I was saying in my investing WhatsApp with my close friends like last week, one of the guys was asking, "Oh, what's like? Give me some tickers, Luke, for some, high risk. I want to have a couple of high risk bets in my portfolio." And I'm like, "Well, look, just go check out Christoph's King of the Jungle, because you got a couple of high risk, high returns options in there, and many of them have paid out, but they're still like great investments." And like my closing comment to that WhatsApp was like, I don't know what's going on with Christoph, right? He cannot miss at the moment. Like literally everything you touch is turning to gold. So
And my, just for the record, ye faithful listeners, Monkey's response, being the wise sage at the top of the mountain that he is, or at the top of the branch, is this too shall pass, because it will. It's just that I hope to gather enough bananas before, and then play the rebound or the downslope as intelligently as this rocket ship. I do want to actually. I want to add to that, because I'm a hybrid kind of creature. I'm long-term investor like you as my base, but I've learned how to maneuver more things in the shorter term. There is, from the trading world, this saying that gets tricky, and like just be careful here, folks. But there's a way when bubbles appear where you can ride the momentum up, and as long as you don't deceive yourself, you could also ride the momentum down and profit in both ways. We'll probably start talking more about that when it's time, but it's not, you don't have to like just you know commit yourself in one direction if you already planning steps ahead. So
Well, let's take the conversation in that direction then, because today I think we're going to start talking about some actual tools and some actual practical things you can do as an individual investor to better understand the stocks in your portfolio, to like start to understand valuations in a bit more of a nuanced way. Like this is a big complex topic, and I think I'd like to start us off on it by talking about something called the reverse discounted cash flow model, because it's really easy actually. It's conceptually fairly easy to understand, and it's trivially easy to do at a sort of simplistic level. But it gives I use it as a kind of, sort of finger in the air test. And I've created actually a template with my buddy Albert's help, created a template that will just run a reverse DCF for you for like hundreds of stocks at a time if that's what you want. And we're going to give that spreadsheet away to Wall Street Wildlife Patreons. So there'll be a link in the show note, but I'm going to show you how to use this thing.
sweet badge. So first of all, I know you've got a good thing prepped here. I know you'll take us through the weeds, but just sorry to burst in, but first thing, when anybody hears the name or title like reverse discount cash flow model, their eyes might go, start rolling inside their head.
Yeah.
What does that mean in plain English?
All right. So let's break it down a bit. So cash flow is like if you're running a company, maybe you're an alphabet or maybe you're just selling hot dogs, like your free cash flow is the money you have left that you after you've you bought like some stuff like a new burner for your hot dog stand, and you've paid like the salaries of the guys that are working with you, and you've paid for a bit of marketing, and you paid for like your pitch in the market, and you've paid for like the raw materials like the buns and the hot dogs. So when you've run the business and you've invested in the business to kind of grow it, the free cash flow is what's left over, and you can decide what you want to do with that. You could either pay it out to shareholders as dividends, and if you're a small person, you could pay that to yourself as a dividend if you're a solopreneur. You could do a share buyback, which is kind of the same thing in a slightly more arcane way, like you're sort of putting money back into shareholders. You could yeah, there's like a bunch of stuff, and it's free. So it's not free as in it's free. You earned it, but it's free to do with as you see fit. So, and companies that are generating free cash flow, kind of, it's like it's a clean way. Takes all the accounting shenanigans out. It's a clean way of saying, is this a profitable company? Frankly, and if your
Okay.
company is like young and immature, it won't be generating free cash flow. But that's not a bad thing. It's just
Right.
where the company is in its life cycle.
Now, tell us about this discounted thing, the D in the DCF.
Yeah.
What,
So
yeah.
if you're doing this stuff the hard way and the kind of proper way, but if you're not on the YouTube, I'm doing like air quotes there. You do something called a DCF, which is a discounted cash flow model. And without getting into like really complex stuff, essentially, it's a complex way of modeling the free cash flow you expect a company to generate over a sequence of years. So let's say my hot dog stand, maybe it's going to generate like $1,000 this year in free cash flow. That's like the money left at the end of the year. And I think next year it's going to generate like $2,000. And then I think, oh, when I get to that stage, I'm maybe going to buy like another stand. So maybe I'm actually going to lose a bit of money because I've expanded my, capex. I bought a load of AI data centers, whatever it is, to run my hot dogs. And but then in the fourth and fifth year, like that's going to pay off. And so I basically I create like a big monster, perhaps, spreadsheet, and I map out all the kind of strategy and the inflows and the spend and the growth and the profitability. And I work out what I think my free cash flow will be every year. And typically it's done for like the next 10 years, but you can do it for as many years as you like. And then, the concept of like time value of money. So, like, if I earn $1,000 this year, that's more valuable than earning $1,000 next year. Because obviously I could have earned that $1,000, I could have invested it or put in the bank, it would have grown a bit by next year. So it's like next year's money is a bit less valuable than this year's money. So you have to do that down
A,
all the
a banana in hand today
yeah
is worth way more than the bananas you promised you're going to give me in Las Vegas in
yeah
right.
right exactly right on
Because who knows, you may never, you might just tempt me
yeah.
to some sinful lair with a bunch of bananas, but then when it comes time to pay up, oops, you ate them all yourself.
And even
Being
if you guaranteed, even if you took that risk out and you guaranteed I was going to give you like 10 bananas next year, you'd still rather have 10 bananas now because you could invest those 10 bananas and you then have 11 bananas next year and that was nothing to do with me. So yeah,
right, plus inflation,
yeah,
plus
yeah,
all the
yeah,
stuff.
totally, totally. So anyway, so now in our heads, we've got like the discounted cash flow model. It's like directionally the next 10 years, the cash flows we expect to get supported by this really big complex model of all the different factors in the business environment. And then we just discount the future cash flows back to today. And then we work out the like the end result of doing this piece of work is we work out essentially what's the fair value for the stock today.
Right. And so, Badge, if I could just, right, just to clarify, in case there's a little, yes, we're projecting how much money the company will make, and then we're taking a little bit off the table because those future bananas will be worth less. So we're kind of adding a little. That's the discount, right? That's the part where we're saying, okay, even if we make this much, it's not going to be worth that much. So we're penalizing those future cash flows a little bit. And at the end of all this stuff, we have numbers, we have a chart based on this bunch of assumptions.
Exactly. And that allows us, based on hundreds of assumptions we had to make to build our big monster model, that allows us to work out is the stock overvalued or undervalued today. Because we might say, oh, we did all this work. We think AMD is worth $300 billion based on this new deal with OpenAI, and the market's currently valuing it at $340 billion. So it's overvalued. That might be a conclusion. But the trouble with these DCF models is they are so sensitive to the assumptions, and there are so many assumptions. And so you could really, I mean, quite honestly, you could build a model that shows pretty much any company is undervalued and any company is overvalued. And you could probably, you just do some work to do it, but you could probably find a justification for that in most cases.
Yeah, Badge, this is so important because in the investing world, some investors are known as spreadsheet warriors, and there's an actual trap here because you could study this stuff and get really really good at it, and as soon as you start plugging in numbers into sophisticated formulas, there's this feeling that, oh my god, I am so smart and these numbers all make sense, and look, I have this 50 column model, therefore it must be true. And we forget the most basic point, that most of it is based on assumptions. And in the early part of my investing career, I was one of these kinds of investors, and I got burned time and time again. And my lesson was stop being too smart for your own good, so to speak. And so, just a big caveat that as long as you remember that just because you typed it into a spreadsheet does not make it so.
Totally, totally true. And look, I'm not dissing the incredible amount of work that some analysts do and that the big banks do. They have like armies of people to do this stuff, quants, like figuring this stuff out and building these models. Like it does work, but I mean, it's just so, it comes down to your assumptions. And so, like, I like it's a lot of work potentially just to reinforce your own like initial expectations, perhaps. Like if you think, oh, I think AMD is overvalued, you're probably going to end up building a model and plugging in your own assumptions that end up demonstrating that it's overvalued. And I know some people go into it and they try and ignore the stock price today. They try and build the model, but we're only human, right? It's hard to do that stuff. Anyway, so these guys, I'm showing a book, if you're not on the YouTube, Expectations Investing by Michael Mabusin and Alfred Rappaport. These guys reversed that process. And it's not a deep book, and it's got like pretty pictures, and it's got, big words. Yeah, there's some pretty pictures there. Look at that. I've read it twice, and I don't fully understand it. Like I definitely feel like I'm like touching the sides of this stuff still, but I'm trying to incorporate this more into my process because I think reversing that entire process. Let me explain what happens when you do that. It's very quick and simple. It's kind of quick and dirty, but it does allow you to do, I feel like a temperature check. So, what does it mean to do a reverse discounted cash flow, a reverse DCF? Essentially, you start at the other end because we know the value of AMD today is whatever we just said, $340 billion. So we know the stock price today, and the idea, Mabusin and Rappaport's idea, was to go work back from today's stock price and simply reverse it with a quite a somewhat complex calculation. I've built a spreadsheet that will just literally do it for you. Just plug in some numbers from Fiscal AI. And from today's stock price and the free cash flow being generated by the company today, a reverse DCF does a fancy calculation and it tells you how much free cash flow growth does the market expect. So I actually did this. I've got a spreadsheet for this, as I say. I'm going to release this spreadsheet to our Patreons for free. And it's a
Which is at
template,
wallstreetwildlife.com.
wallstreetwildlife.com, absolutely. And it's dead easy. Like this spreadsheet, I've got instructions. It's really easy to do this. And you can either do it manually or you can just plug in data from Fiscal AI. And if you go to fiscal.ai/wildlife, fancy discount, you don't even need to pay Fiscal AI. Like you can do this stuff with the free tier. So if we look at this, I've updated my reverse DCF for these are like my main stocks in my portfolio and a few that I've got my eye on that I'm not buying, I don't own today. And I refresh this every couple of months to do a bit of a temperature check. Now, and then it's like nice and pretty, and I've just sort of ordered it. So I'm just going to pick out one or two rows from this because, like, this tool is no use at all if a company is young and they're not generating free cash flow. Because, so for example, Rocket Lab, New Holdings, ASTS, like these companies don't generate free cash flow. And so you can't do a reverse discounted cash flow model because you've got nothing to reverse to. And then you've got some other companies. There is a weakness in this model because, say, finance companies, fintech companies like Wise, and actually it hasn't come up in my model, but I'm just showing it for transparency, Mercado Libre, and a few others, the way some like financy companies account for their free cash flow in that because of like standard accounting rules, the model doesn't really work either. And it's in Wise's case, it's because they hold a crap ton of customer deposits on their books. And you have to understand the intricacies of how they manage their cash flows to realize that like the very, very big free cash flow number you see in the standard accounting statements isn't a true reflection of their free cash flow. So the model doesn't work for those. It didn't detect Mercado Libre, but it's just like you know, like my spreadsheet is good, but it's not absolutely perfect. So you need some nuance. But directionally, this allows me to do like a temperature check across the whole portfolio. So I can see like directionally companies like Novo Nordisk and C Limited, like down towards the bottom. Let's pick out C towards the bottom of the list. So if I do this Mabusin reverse DCF, based on today's valuation of C Limited, the market expects 11.2% growth in free cash flow over the next 10 years. So I can ask myself very simply the question, does that feel about right? Like, and I have to know about C and know their competitive position and where they are. And they've done a turnaround and they've been on like a cost cutting like regime for the last couple of years. And now they're starting to grow and expand again. And, knowing all of that, I use my investor knowledge and my instincts to say that seems pretty reasonable. In fact, that seems like it might be a little bit cheap. 11, I think.
So yeah, to summarize a bunch of stuff here. You find a company that's already making money, free money, more than it needs. Okay. You then plug in the numbers into our fancy spreadsheet, and it's going to give you a number, the growth rate number. That number tells you, based on this current valuation, for that number to be justified, the market expects this company to be growing at the number that popped out of the spreadsheet. In C Limited's case here, it's 11.7%. And Badger is saying this is where more of the art, so to speak, comes into this. Does a company like C Limited, that's already yay big and has this and this going on in terms of their market and in terms of their tech, is growing 12% a year for the next 10 years? Does that make sense? Does it feel like, oh, yeah, about right? Or, oh my God, there's no way they're going to grow 10% a year for 10 years because they're going to start losing subscribers, or this, or competitors coming aboard, whatever. And then but it's a base. It's a good base from which to gauge expectations.
And let's go to the other end of the table, because I've got two stocks I want to pick on that are at the like extreme high end in this reverse discounted cash flow model. And this is why it requires nuance as well. But I actually did a trade on the back of this analysis end of last week, which I notified on our Patreon on the trades channel. So Transmedics, the market expects 46.5% free cash flow growth over the next 10 years. Palantir, the market expects 45% free cash flow growth over the next 10 years. So those are both very, very high numbers. Like, to grow free cash flow by nearly, say, 45% year over year over year is hard. Some might say impossible. And if they succeed in doing that, that meant it's correctly valued today. That doesn't mean it's cheap. That just means it's like correctly valued. To be buying it as a bargain, almost, for it to be a good investment, they have to grow free cash flows faster than that, or for a much longer period. So I've trimmed my Palantir stock yet again. And I think I may have said like 6 months ago, I've trimmed it 3 or 4 times. I'm not going to trim it again. But like, I had 3% exposure in my main portfolio, my retirement portfolio, sorry. I know I said I wouldn't call it main. They're all main portfolios. I trimmed it from 3% down to 2% because at the scale that Palantir is at, and all that stuff we talked about AI bubbles and risk, I don't think Palantir can grow free cash flow at directionally 45% year over year for the next 10 years. Because I think we're going to see personally, I think we're going to see like a come to Jesus with these AI companies, and a lot of valuations are going to get reset, and all the money that people are spending on AI, like a lot of that is flowing to Palantir on the software side. Like, that's going to slow down, and then their free cash flow growth is going to slow down because, they're inside the bubble. Transmedics.
Wait. May I? Before we switch over to Transmedics, so yeah, the bulls regarding Palantir are saying, okay, this is going to be the software layer, kind of covering all AI. And if AI is this new magical thing, then there ain't no valuation high enough, right? Like, this is gonna, it's that the law of large numbers just stops applying here. And when we say back to them, you're telling me that 45% a year for the next 10 years, that seems reasonable to you? They're like, yep, that's totally reasonable. And we're saying, yeah, but that'll be like, this time it's really, 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 really different. And it's starting at what, 200? What's its market cap now?
Well, and that's key, $410 billion today.
Exactly. So
Right.
to keep that kind of compounding, in one sense, they're saying this might become the world's most valuable company. That is one of the implications from the bull case. And you, as the bear in this case, by trimming, you're saying, uh, I'm separating my confidence in the company from whether this is a smart investment, and the numbers are telling me that for any of that to even come close, the company not only has to exceed, like basically out, like it has to not make any mistakes, one, and that, yeah, it'll just be a new unicorn kind of thing being born into existence. And probability wise, if something has never happened before, you should be very, very cautious.
Exactly. That's exactly right. And just to be clear, like I'm not a bear. I've still got 2% allocation to Palantir. I still want to be exposed to it. I just want to manage my exposure and trim it because I feel like it's just like too expensive right now.
Right. And I'm saying, and Monkey doesn't have Palantir because he's taking the full logical conclusion, which is it's just an a not an insane bet. The risk reward ratio to allocate money here is skewed to the risk side, and I want no part of something like that.
Yep, that's fair. That's fair. Yep. Now let's just quickly look at transmedics. I don't want to go down a rabbit hole with it, but we did talk about it in episode 100 when we were like drinking cocktails. Because the market also expects transmedics free cash flow to grow 47% a year, 46.5% per year. So you could say, well, obviously that's overvalued as well. But you've got to know the story and you've got to know where it is. Like Transmedics is a $4 billion company and it's really only just pivoted to generating free cash flow. So it's like really immature in its free cash flow journey. Like almost, I perhaps I should just be ignoring this line entirely because it's not really a free cash flow story at something like Transmedics. And even if it was, I kind of do believe that they can grow at a much faster rate because look, they just started announced that they're going to like penetrate Europe with like having like airlines in or planes in Italy and so they're early in their story, whereas Palantir is a lot further along in their story.
Exactly. Yeah. So it's a little bit of nuance there to flesh out what you just said, Badge, is that uh, Transmedics might as well not be making any cash flow. The fact that it has some right now,
Right,
that's almost like arbitrary
right,
because it has simply too many investments yet to make in its own expansion to be considered a more mature company. And when we talk about, adding the kidneys and international expansion like you did,
yeah,
they should really be putting all of their uh, money and profits into the expansion stuff. So yes, it's a fluke that it's on here, and that cap size 4 billion is not 400 billion.
exactly. Yeah, exactly.
So I
So
would ignore, yeah. So another nuance, I would ignore Transmedics altogether.
yeah, but I wanted to draw a line to it and say, don't just so you can't use any tools like this in an unthinking way. Anyone who thinks they can create like a spreadsheet or even like some giant AI model and plug in data and it will tell them just magically and accurately, should you buy or sell a stock? That's a fantasy. That doesn't exist. And if it did exist, it would get arbitraged away within hours because someone else will find it, or they'll notice some of these like hedge funds and other like sophisticated market players that have they're paying their analysts like nine-figure salaries. Like these organizations will find that, or there'll be a fast follower, and if you found some inefficiency in the market, like it will be gone within probably within seconds, let alone within days.
Yeah. Now, speaking of inefficiencies in markets, this is kind of curious when I'm looking at this chart here. Usually, the inefficiencies exist in small companies because the market hasn't really found out about them and they're growing at rates that are unusual. Those inefficiencies are rare when you're talking about the mega caps. Uh, some obvious examples recently, like there was the Nvidia and the Meta story, right, where there was this big divergence, and then but that's the exception. However, looking at this list, Badge, to go back to our portfolio reviews that we did in episodes 9091, I see Alphabet is expecting, based on share price, about 15% annual growth, whereas Amazon is expecting 30 and Axon is expecting 40. These are three of your companies. And when we did those pitches, you convinced me to, I actually went out and bought some Google, uh, not much, but like for me, a little placeholder to say like I buy the moment. And right now I'd be hard pressed based on this, because I was tempted to add Amazon, and I was a little tempted to put the same placeholder on Exxon. I'm like, nope, because why would I do that if my Google position is still small and it's basically 50% off? If you want to sort of think of it that way, it's 50% cheaper than those other two. I mean, that's not quite apples to apples, but
No, you're,
roughly.
but you're right. Like I did that same, slightly more sophisticated version of that same thing, and I came to the conclusion a year ago, Alphabet was just a complete no-brainer investment, which is why it's the only stock in the last 20 years where I've added new money when I already had more than a 6% allocation, and it's still cheap now. Like it's up, nicely 50% or so from the last time I spoke about it, maybe 6 months ago. I think it's still very reasonable value. Amazon has always been a funny one. I've owned it for decades, like coming up for 20 years. Like they still, like as Bezos used to say, I know he's not at the helm anymore, it's now Andy Jassy, but they used to say it's still day one. Like they're still investing a crap ton of money in warehouses, logistics, airlines. So actually, like the whole, you think of Amazon as this like e-commerce giant, the whole totality of the e-commerce thing, it doesn't actually generate much in the way of profit or free cash flow because they spend so much money in just continually growing and out competing anyone who could possibly come after them. Like it's impossible to chase Amazon on logistics now. But they make some free cash flow because AWS is such a cash cow. But Amazon is weird. Like it's not really a free cash flow story in a similar way to Transmedics, funnily enough. Axon is just overvalued. Like that's in that category.
Okay, so that was great. Are we going to do a more another kind of live tutorial with plugging in the numbers, maybe on a future episode?
We can, I think, let's take some questions on what I've just shared. I will post in the show notes for today the links to the spreadsheet, but you'll be able to get them from wallstreetwildlife.com, which is our Patreon. And like have a play with it and then hit me with some questions and I'll try and field those. But I think I would like to, we should both start using fiscal.ai in a more interactive way because I use it every day. And like I've adapted my spreadsheet so I can literally just cut and paste all the raw data you need out of fiscal.ai and I'll show you how to build like the dashboard template you need in the template. It's dead easy. Like in 20 minutes, you can have this thing up and running.
Yeah, that's what's going to be so useful. Maybe that's something we do for our Patreon only crowd. Like a video, us taking a ticker and you starting from beginning to end. uh, Here's the whole process, and that I think will be extremely valuable for our community. Sweet, we've babbled on for what, 50 minutes already. Shall we get to our Patreon questions?
Yeah, let's do that. We had two really good ones. Do you want to pick us up first of all with Barbara's question?
Sure. Barbara writes, Dear Mammals, I would love to have an episode on insurance and hedging. I follow the IO fund and see their pattern of strategically hedging, but they do not have a diversified portfolio, and following their hedge signals seems to make sense if you have a portfolio that does not diverge greatly from theirs. So, should we read Stephen's reply?
Let's just dive into our thoughts. Like essentially, Barbara's saying, how do I protect my portfolio? How do I take out insurance on my portfolio if there was to be a downturn?
Yeah.
Actually, let
This
me
is
let me go first because I've got a really simple answer.
great.
But the real answer is your more complex one. Like the really simple answer is I just have a bigger cash allocation. That like Barbara, that's my insurance, and I vary my cash. And if I think valuations as a whole are probably stretched, and I think we're getting to that territory, I'm going to start increasing my cash allocation. I did that just by selling 1% of Palantir last week, and I'm going to start trimming some other things soon. And by having more cash, if stuff goes down, well, the cash becomes more useful. I can redeploy it at cheaper valuations. So there's a simple answer, but there is a more sophisticated answer, which Christoph is going to run you through.
To your point, that does involve a little market timing, but it's balanced out by the whole sleep well at night quotient. If you think things are, or I'll say it this way: if you've already made a good chunk of money the whole point is to make the chunk of money. It's not to make even more obscene amounts of money that you really didn't think would happen or you would need. Then it does make sense to market time and say, okay, I've accomplished what I was set to accomplish. You take some off the table, you sleep better at night, and now your cash is that insurance that when the market drops, you actually are, I'm not sure if excited, but you don't feel that upset because you're like, oh, I get to reinvest this for much cheaper, right? That's how that works. Cash as insurance. I would offer two alternating strategies that use options as insurance. Because I say this all the time. In the options market, there's a buyer and there's a seller, just like when you buy literal insurance. So let me repeat that analogy. When you have a car, you're forced to buy insurance, right? Money leaves your account and goes into the account of the insurance company, and it pays out when things go bad. Otherwise, you don't get that money back, and you know you're not getting it back. Hopefully you're not getting it back, right? Because hopefully you don't get in a car accident. So it's a deal you're willing to make up front for peace of mind. One of the ways you can have some insurance is to sell calls on your positions. So what that means is, and I'm not, this does get complicated pretty quick, but once you think a position has reached fair valuation and you're ready to sell it, an alternative could be that you sell call options, meaning you collect premium from somebody else, and that says you pick a price that you would be legitimately happy to sell those shares at. So let's say it's $20 for company X, right? Instead of going to the market makers today and just selling them outright, you sell a contract to somebody else. They pay you, you get money. So you've basically collected. I'm calling that insurance. And then if that company then exceeds that price, you sell at that price, they get your shares, but you keep the premium. If the company does not exceed that price, then you keep your shares and you get to sell call options in the future. Now, in general, I've won and lost a lot using this. I've won when it's a company that I legitimately want to get rid of, but I just got rid of it with a little extra in the pocket for a little higher. But I've also lost because I decided to sell shares I'm sorry, covered calls on a company that had a huge growth rate. And then, of course, it kept going up. And basically, I didn't really want to sell that company. So this works more for the sort of steady, for the steady companies. Does that make sense?
Yeah, and it's almost, I know you're going to come on to another version, but this is a bit like the opposite of the thing you described at the past, because in this way, kind of you're almost becoming a version of the insurer. You're getting paid, like you're receiving dollars in your account, and you'll keep that money as long as stock prices stay kind of relatively flat, depending on kind of
Or go down,
or go down. Yeah.
or go
Um,
down.
yeah. And if things go up, then you'll end up selling your shares at a discount. Like you'll lose a bit of money when those options get exercised. So you're
Yeah.
kind of you're being paid money today, which you'll only keep if stuff remains relatively steady or goes down. So that's kind of like where the insurance bit comes in. It's almost like you're almost like the anti-insurer for someone else.
Yeah, I'll rephrase this a little bit. Selling calls on companies you own that you're happy to sell at the price, at the, call it, overextended price. This is just a way to squeeze a little extra money on top of where you're okay selling it anyway, because you're collecting a premium above the price that you'd be happy to sell. So this is like insurance light, right? Um, no, you need to have at least 100 shares of a company to sell a covered call. So for some people, that this might not apply. But the real, what I would call full on insurance, would be almost the exact opposite. You would buy puts. Puts and calls are the two option vehicles, main option vehicles, and you could either buy or sell them. We talked about selling calls where you get the premium. When you're buying puts, you're giving money to, call it, the market. So you're paying for that insurance. But if things go down, then your puts increase in value. So if you have, just I'm going to use an arbitrary number here. If you have a portfolio of, say, call it $100,000, you may decide that you are okay losing, say, 5% of that portfolio, meaning losing via insurance. So you would then do some math, right? 5% of 100,000 would be $5,000. And you would say, okay, if I lose $5,000 relative to the other 95 that I own, no big deal. That's how insurance works. And you would buy $5,000 worth of puts in some vehicle that will go, that you expect to drop. And as that vehicle drops, your puts go up in value. So your $5,000 would go up to 6,000, 7,000, 12,000, whatever it may be. And the common way of doing that is you pick an index. What I would do right now, given where the AI bubble lives, it lives on the NASDAQ index, right? So I would pick a NASDAQ index that kind of maps all of the frothiest companies and buy puts on that. So a common way of doing that, just to throw out one ticker, is QQQ. That kind of tracks the techie stuff. And then I would buy, I don't know, then you have to consider the date, right? The date of this, because options lose value. So let's say you buy the insurance for a full year because you don't want to get really cute, right? Thinking it's going to be 3 weeks from now, because you're not going to get that right. So a year from now, you buy $5,000 worth of those puts. Market does drop, those puts go up in value, and you've therefore hedged or protected some of your portfolio. And obviously, if the market continues going up, well, you lose the 5,000 bucks essentially, but your portfolio, the other 95% of it, is now worth more. And then you could repeat the process when the bubble's even loftier, something like that.
And that's much more like the sort of traditional concept of insurance. You spend a bit of money now in the hope that you don't cash in. But if your house burns down, if your portfolio explodes, then you can cash in your insurance policy and hopefully get back like a chunk of that money.
And to go back in our time machine badge, remember when poor humble monkey, all the moves he was making in the first year of our show backfired spectacularly. I won't mention the Rocket Lab call that expired at zero again, haunts me. But I also bought a bunch of puts in KRE and BAC, and that was because I was fairly convinced that the commercial real estate bubble was gonna pop. And for a little while, things were looking really, really, really dire. But that did not happen. The banks printed more money, and for whatever reason, that still, the fates kept the commercial real estate titans afloat. But that was a bet I was willing to make. I lost thousands of dollars, but that's how insurance works. So right now, I would be thinking in that way. Your task as a listener would be, yeah, find things that you think are likely to go down when the market flips.
Now, I wonder if I can be a bit cheeky and show you a particular put I would like to buy, and you can give me some action advice on it. Because a bit like you said, okay, you could be smart and you buy like this insurance policy and you buy puts on QQQ, like the whole market. You can still buy calls and puts on any individual company. And I think quantum computing is total BS. The ass is going to fall out of it, whether or not AI succeeds. There is no business model here. And I know some people don't agree with me, and that's their prerogative. I believe this stuff is all going to pretty much zero. So here is the actual, it's called an option chain. And I've taken a snapshot of Quantum Computing Inc., which is a company we talked about a while ago. And I think this is one of the most egregious, like, wastes of space in the whole stock market today. And here's a snapshot from about an hour ago. So on the 6th of October. And I can buy January 2028 puts. So, i.e., a bit like an insurance policy, or I'm betting the stock will go down sometime in the next 837 days. So, I've got like a really long insurance policy that, in my mind, that should be long enough for this thing to like collapse down to the steaming pile of detritus that it is. So, but I think this is terrible, terrible value, but I am an options noob. So help me understand the options chain. Maybe you can start to explain what this picture is showing us and tell me if there's something worth buying on here.
Sure, Badge. So I would say let's start from the back. I think it's dangerous with this particular setup, and the following reason is when you're dealing with circus company like this. Um, we know it's mostly momentum, and momentum can keep going for a very long time. And technically, when you buy a put with each passing day, you're losing money. So the fact that you're looking at the 28th of January is a thumbs up. But the main thing is so without because we need a masterclass on options really because there's a lot of moving parts to keep track of. But let me call your attention to one thing specifically. Uh, I see in that top row the IV last number is close to 140%. IV is a algorithmic number come up by like quant funds that basically tells you uh, what the market expects the implied volatility to be. And the higher this IV number, the higher the algos think the swings are going to be, both to the up and down. This number changes every minute or second. You could look at it and it's going to be changing. An IV of 140 is very, very high. What that means is that the people selling you these options are charging you a lot of money to buy them. They're basically saying, we know this this qubit company is going to have a lot of woo. And if you want to benefit from the potential fall, oh, we ain't going to make it cheap for you. So what many options market participants do is they either look at that and say it's too high, I'm not gonna pay you that fee, or they wait for something to happen and it's called IV crush, and they wait for that number to drop. Often, to give you a clear example, that you will see with let's not use a bizarro company like Qubit for now. Let's use a normal company like say Amazon. The closer it gets to an earnings call, the higher the IV gets because we know things could shoot up massively in which you'd profit or you drop, and you'd lose money depending on which side of the trade you're taking. So options people who legitimately want to buy an option in say Amazon, and let's say they're doing more of a short term thing. So let's say over a 3-month period, right? Then they will wait post earnings or maybe call it post earnings, but not the day before, not the day after, but let's say sort of in the middle of the 3-month cycle, maybe a month after it, that IV you always see dropping precipitously after an earnings call. That's when your options are cheapest. So that's kind of just an important concept to understand. All else things being equal, time your purchase when it's cheapest. Qubit's a whole different beast, right? Because there's no there. And so it seems like if you want to take this bet, you have to swallow the fact that it might not get much cheaper until it kind of goes, bankrupt. What will happen first? It either proves it's legitimate, and lo and behold, they do have a sophisticated fab that nobody knew about, or it's gonna, plummet to close to zero because whatever thing happens. So here, I would say the numbers that what you're seeing is not going to help us much because your thesis is true or it's not, and you're going to pay one way or another. you're going to pay to partake, and there's no alternatives.
Yeah. So like and if we just, if we can, editors, you can keep this picture up, the QUBT one. Like if we look back at this option, just to pick out some of like my simplistic view, like the stock is trading at $21, give or take. That's like the little black number in the middle today. If I wanted to buy the right to sell the stock at $20, so kind of directionally what it's worth today, in up to January 2028, I got to pay about $9.64. That's like the last time a contract executed with those parameters, the deal closed at $9.64. So, and you buy in batches of 100 when you trade options. So I would pay, the minimum I could do here is I would say spend $964 to have the right to sell 100 shares at $20 over the next 800 days. So if I've paid $9 for the right to sell the stock at $20, and the stock is $21 today, well, the stock has got to fall to like $11 before I'm even touching a profit. So that's like the stock has to get wiped out. And even if the stock literally went to zero, which is probably improbable, it might get down to, it might like get quartered. It's like a $5 billion company today. Let's say it gets quartered, it goes down to like $4, say. Even then, I'm still only making like $500 on that option I bought. So it's not much of it's like expensive. I'm spending $900 for one contract to potentially, at the best case, make $400, but probably just like exercise is worthless because it was so expensive. And that's like, your IV number is like the algo summation of like the cost of the thing versus the strike versus all the different dates, because there's lots of different things I could buy. That's like a summation of all those different things I could buy or sell.
Yeah, there's a perfectly reasonable view to be had here that's saying, to go back to my original point, when you're dealing with something that is based on pure market game theory, then that game is a game you might lose simply because the mathematicians will it so. Um, a thing to keep in mind, though, with options is that you don't have to wait till the options value will change continuously. Uh, it's not like you have to wait until January 28th to either have won or lost the bet. And so the moment Qubit turns out to be a fraud or whatever, your options would uh, gain value. But then let's say it happens tomorrow, right? Let's say the stock drops to $15 a share. Your options actually they don't need to hit 11. Your options would really go up in value because there'd still be a lot of time value left on the contract. Because remember, options are what you pay is both the premium, the intrinsic value, and the time value. So it's like time value, intrinsic value, and the multiplier of the IV. That's a fancy way of saying um, time is on your side in this case because it's so far out. But you still have to be correct. And I guess my net takeaway from looking at this chart badge is you just have to be extremely confident that this thing is not what it is. And then I think it's not a bad play given you're giving yourself what 28. It would be 2 years and over 2 years and quarter. And right, to bring us back, as an insurance play, we know that if there are gigantic red days coming and something's popping, then the companies that will pop the most are ones that not only don't have any revenue, but that are known to the market as potential nothings. So this, I would say, is not a bad way to get some insurance. It's kind of like it's kind of like exotic insurance. But it would be still insurance. I just bought two of these puts, but for January 26th. So that's more like gambling territory.
Yeah, cool. All right, great, good. All right, well, I'm going to take that away and think about it. But if we come back to Barbara's question, it can be much simpler than where we just looked at QUBT. like QQQ puts will be a way of doing that. If you want to get into more detail, Barbara, like message us in the Jungle Lounge community on the Patreon. We can go through a live example. Maybe just as Christoph asked me to do like a live show and tell for our Patreons about how you use the reverse DCF spreadsheet. Maybe he'll post a couple of QQQ puts and give you a bit of insight on those.
Yeah, and right, and there's some good tools, good options tools that show you pretty charts, and so yeah, we could do that in a future episode. Cool.
Let's. I know this has been a long episode, but let's touch on Sylvia's question as well because I promised her on the Patreon that I'd field this one. So Sylvia has asked us. So she said she's a complete beginner, and she wants to know how much time should she be spending researching stocks. And then I think it's sort of a separate question. Like she wants to manage her anxiety, which we all have as an investor, and like how much is too much of an exposure to in any one stock. And as a bit of context, she said, she's not like early in her investing career. She might be a new investor, but this is money that she will need in the next 10 years. So therefore she has to be somewhat conservative. So let's dive into that a little bit. Maybe the first part first. Like how much time should you spend researching stocks? You don't need to spend any time, right? You don't have to do any of this stuff. You could literally buy an index, DCF. You could set it up in half an hour, and that's it. You set your financial future. If you want to know how to do that, go back to our episode where we talked about like how to get started as an investor, or even listen to like how to invest for your kids, because we set out a roadmap that's applicable to kids, but also applicable to grown-ups too. It can be like autopilot, but the stuff we talk about on this podcast is going a bit beyond the autopilot and actually analyzing companies and starting to understand the world through the lens of being an investor. How much time should you spend on that? How much time you got?
Well, I got a better answer.
Go on.
To take our doomsday scenario seriously, assume the market's gonna puke.
Hmm.
If you're thinking like an investor and not a trader, then you own the business, right? Whichever ticker you bought, you own that business. And this is a thing made by humans. Let's call it 1,000 humans got together and dedicated their whole lives to building. And now it's worth $100 billion, let's say. Or if it's Nvidia, it's worth $3 trillion, right? Meaning this is like a seismic accomplishment. When the market pukes and you're thinking of an owner, are you going to just literally get rid of this thing that you've built and partaken for 25 years simply because the price drops? The only way you answer that is if you truly understand what you own. You wouldn't sell your house, right? Just tomorrow because you got some raccoons in your attic making noise, right? It'd be obscene, right? The smallest sound. No, you understand your house. You understand its foundations. You understand that a little raccoon in the attic is it's not affecting the whole house. If you have no idea about your house and you have no idea where it's located and you have no idea, right? Then maybe a raccoon is a harbinger of bad things to come, and you'll be like, okay, out with this thing. So my point is, if you understand what you own, or the more you understand what you own, the more likely you will not make a bad decision to sell out of panic, out of fear, out of temporary market gyrations.
Yeah, that's fair. That's very fair. But and if we try and make it really specific, like what do we think is okay? Let's put a finger in the air. Like if you're a beginner investor, and this isn't you have a job, like you're doing other stuff. This isn't your like hobby and passion, but you're interested because you're listening to this podcast, and you're starting to own a couple of companies. Like in this thread, Sylvia tells us she owns Nvidia, and she's owned it since like $120. So she's been in that for quite some time. What's the minimum you could get away with doing, and how much time will that take? I mean, I would say to be like your first baby steps as a proper investor, I would say the minimum you should do is check out the quarterly reporting. Like just skim the deck, which might take you, I don't know, 2 hours, like 4 times a year because it's quarterly. And if you really want to understand it, it might take you a day or two because you have to go and you have to go and Google some words you see in the deck and understand them a bit better. And if you've got like an extra half day, listen to the earnings call again 4 times a year, and you might have to go and Google some stuff that's talked about. Why did an analyst ask a certain question? Yeah, so that maybe and if that's one company, by the way, it's one company. If you own 10 companies, that's that times 10. I would say to be a proper investor, that should be your first step. You can do less than that, which is already if you do just that bare minimum, quite honestly, you're doing more than like 90% of individual retail investors that are in the market.
Yeah, and I could add a little bit of nuance there and say do things in little steps. So I have my one share watch list method. Step one is I go to the company website and I look at the investor presentation. Those are the shiny slides. This is the company selling itself. Once I go through, let's say 25 slides, that's taken me what, an hour, 2 hours, right? Because I go on side quests. I look up, Lightbridge, for example. I'll weave this in as a good example. A recent purchase I made for the King of the Jungle portfolio. Uh, Never really heard of it, but I know Oklo or nuclear energy is the market's going gangbusters over this. Another bubble, but Lightbridge is going to be selling call it the nuclear fuel for all of these, and there are partnerships, and there's lots of good stuff going on. Well, what did I do? I went to their website and I looked on their slide deck, and then that took me on a side quest to the CEO talking about the recent uh, expedited stuff happening with the government. And I didn't want to outsmart myself. And I said, well, okay, let me pause there. That took me hour, 15 minutes. And so I bought a small little position in the King of the Jungle. It's like 0.3%, I believe, of my portfolio. That was enough for me. I liked what I saw to put it like into the portfolio. But that's nothing, right? 0.3%. If it goes to zero, nothing bad really happens. But now it's in my portfolio, and as I get more serious, then as Badger is saying, I'm going to listen to the next earnings call. I'm going to go back, look at the finances more carefully. That's going to add several hours to the project. That's going to determine whether I add to it. You don't have to buy everything at once, is the point. You go little by little. So on the extreme end, of course, like when I went nuts over EOS, I imagine it was over certainly hundreds of hours, maybe 500 hours of research continuously for years. But yeah, you don't need that. But that's how you gain conviction. So between 2 hours and 1,000 hours, the truth lies.
Yeah. And if it feels like work, maybe you need to invest in different companies. Because if you're passionate about being an investor and you're invested in companies in sectors you're interested in, like we're both interested in tech. Christoph and I have got like between us 3 Teslas on our driveways, right? We're interested in what the company's doing. So when I read about Tesla and I listen to an earnings call, or I catch like a Musk like shooting off on a podcast with Joe Rogan. That's not work. That's actually like hobby and passion. It's interest. But I learned something about the company at the same time. So yeah, Sylvia, it feels like work and it feels arduous and boring. Maybe reassess. Maybe find a different set of companies to sink your time into, or maybe decide like I don't have the bandwidth and I don't have the interest to do this. Like just put the majority of your money in an index and DCA for the next 10 years and you could do just great.
Okay, this is perfect. Perfect segue, Badge, because we're going to end the episode with me giving you some homework.
Mm.
Yeah, you love this. You love this. Okay. Uh, because it speaks to this point. Um, I also bought a new company. I added a new company to Monkey's King of the Jungle portfolio, PayPal,
Ah,
ticker PYPL. Exactly. Now, why did I do this? This is a company I had studied before. So, and when we were on Seven Investing with Matt Cochran, I heard all the spiel. So it's not like this company was new to me. But in general, I don't. Uh, my area of expertise is not fintech stuff. I don't know the nuances of take rates and friggin', like I'm just not a fintech guy at heart. That's Badger's area of expertise. However, Saturday morning, I ended up spending, it was about, I would say, loosely 3 hours because in the previous week, using all my fancy monitors and different sources of information, I kept getting pointed back to PayPal. And I began, this is the intuitive thing you get when you invest for a long time. After I looked at the charts and the technicals and the finances and looking through the presentation and looking at bear cases and bull cases, I got a deep whiff of this is the perfect moment to start getting serious about PayPal because there's a lot of negativity still clouding people's perceptions because it's been a long time that this company has been in the dumps. But when I looked under the hood, Badger, and this is your homework, 2 weeks ago, I believe they announced a pretty big partnership with Google. See, you see. And when I read I read both bear and bull cases. What I saw was a company that had made many strategic shifts, many of them under the hood, many of them not visible yet to the market, but they've been doing them behind the scenes, and that this smells to me like the exact moment when there is the most what's it called the most doubt that's not yet visible, and that the whole you want to buy when nobody else is buying kind of thing. And so I ended up buying one share for the king of the jungle portfolio. Your homework, Badger, is because you like fintech, because you understand it, because you're invested in many of PayPal's competitors, Adyen and Wise, and is Nubank a competitor?
Yeah, kind of. Yeah.
Okay.
Yeah.
Uh, then I'm telling you, monkey to badger, that using your expertise that I don't have, if you put PayPal on your to research list and you get rid of the things you don't like about it, because there many of them are still true, and many of those things are still relevant, you'll be able to speak to them better than I can. But you look at some of the things that they have done, I'm guessing you will be pleasantly surprised at what you discover, and I wouldn't be shocked that you might take PayPal more seriously going forward. So that's your homework. Research PayPal and tell us what you like and what you don't like.
Nah, I'm not going to do it because I'm leaning on the advice we just gave Sylvia, which is if something doesn't interest you, and if it doesn't turn you on, it's going to feel like work, and I don't want to do work. I've got much more interesting things to research. I so I'll take a glance because you said Google, which obviously I can't. That's like a red rag. I've got to understand what's going on there. I'll look at that, but I ain't researching the stock because I don't want to own it. I just, in principle, I do not like them.
Gonna
And I don't
make
mind missing out. I don't mind missing out on a good investment because I want
Yeah.
to own companies that I like and have a mission and are making the world a better place through technology and innovation. And I don't reckon PayPal's one of them. And
Well, I'm gonna
even
call
if
you out
there
here.
are, there's only better options.
Okay. I buy that you have more interesting things, but you do have a bunch of fintechs that are their competitors. So you're doing this
Yeah,
kind of work anyway.
sure.
And
As a,
for
as a analysis of the competitive landscape for Wise and Nubank, I would look at it from that perspective.
There you go. You could look at that. It's now tied up with one of your top conviction holdings in Google.
Okay.
Uh, and Venmo is growing 20% a year now. So it's like turning from the stodgy thing. Like there's just, it's fine. It's fine. Go ahead. Make Monkey do the work in fintech, which he doesn't even understand, but that's fine. I'll do it and I'll buy a whole bushel of bananas and then You'll laugh when it all went wrong, or I'll screech at you saying "told you so." But this is good. This is good. You're drawing a fine line. You're just saying, maybe not for me. I'm challenging you. I'm saying you're going to be surprised by what you find.
Yeah. All right. Very good. I like the spirit. Okay. All right.
Okay.
All right.
Let's end the show with just a little bit of the chit chat. I got a pop quiz for you.
Ooh.
I'm curious. I doubt you'll get this right. In my other life as a professor of English / rhetoric, there are two literary authors that I am most knowledgeable about because I've published professionally on them. Can you name either of the two?
Oh God, it's the journalist guy. Who's I can't think of the name. The one who did your the Beauty of Roger Federer thing. That guy.
Yeah, David Foster Wallace, right?
Foster Wallace.
I wrote my dissertation titled "The Buddhist Philosophy in the Work of David Foster Wallace." So he's my number one guy. I got a tattoo of last line in that book on my shoulder. I got his initials on my wrist. So he's my number one man. But number two is Thomas Pynchon, and I won't say more here, but he's maybe one of the most crazy, cracked out, brilliant minds of the last 50 years. I mention this because he's secretive. Nobody has seen a photo of him since his high school yearbook in 19 whatever that was 60s. He's appeared on The Simpsons once as a character with a brown bag over his head and a big question mark over it. So he holds his identity very close. He protects it very, very closely. He must have given the rights to Paul Thomas Anderson, I think one of the best filmmakers in the world today. And P.T. Anderson made a new movie based off of Thomas Pynchon's novel Vineland, which was released in 1990. I saw it yesterday. I think it's one of the best movies I've seen in the last 5 years. And now, as a Pynchonian, maybe I'm completely biased, but see this thing. It's just it captures our moment in time, or in America at least, but also for you Brits too. You're dealing with the same kind of stuff better than any artist I think has captured it in a long time. So one battle after another in the theaters. Tell us what you think in our non-investing watering hole.
Awesome. I will definitely check it out, and not only because of that. It's also got like DiCaprio in it, who is a great actor. But also my buddy Tom is seeing it tonight. He just WhatsApped me, and he's been incessantly talking about that movie for the last 3 or 4 days. So I got to see it because I'm seeing Tom for dinner tomorrow night, so we can chat about the movie.
Oh yeah, no, and let's talk about it on our Patreon, which is one of the things that we do. So if you're watching us on YouTube right now, cool, thank you. But if you want to actually interact with real humans who have real conversations over on wallstreetwildlife.com, that'll take you to Patreon, where we have a non-investing channel where we could shoot the shit about things like what you thought of one battle after another. Monkey gives it 6 bananas out of 5 bananas.
Wow. All right. Okay. Well, if it's as hot as your stock picking has been in the last 6 months, then it's a must-see movie.
Cool. All right. Are you ready to be a beast of an investor?
Your journey starts right here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.